Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Bank of Nova Scotia topped estimates on better than expected results in the first quarter at its Canadian banking division. The bank saw earnings growth across all divisions, including domestic, wealth management, capital markets, and international. The Toronto-based company has been slashing expenses to improve operations and says earnings growth should accelerate in 26. Shares of Thomson Reuters climbing today. They're up 11.7% right now. The content and technology company says it reached 1 million professional users on its legal and business artificial intelligence tool, and it is working with Anthropic's Claude model. The Toronto-based company also mentioned it was working with OpenAI's GPT and Google's Gemini. This is Reuters' biggest intraday gain since October of 2008. Shares of AMD are climbing today. Meta will buy AMD chips and computers designed to run artificial intelligence models over a 5-year stretch beginning in the second half of 26. According to the chip maker, the transactions will be worth double-digit billions. As part of the arrangement, Meta will receive warrants to buy 160 million AMD shares. Last week, NVIDIA disclosed a similar tie-up with Meta. Warner Brothers is considering a new takeover proposal from Paramount. The Hollywood studio did not specify the terms of the new offer, but Bloomberg News is reporting that it was higher than the $30 a share Paramount was offering previously. If the new offer is deemed superior, Netflix will have 4 days to make a counteroffer. In the meantime, the Netflix agreement remains in effect. And taking a look at the markets. The TSX pushing towards 33,900. It's up 0.3%. After that slightly off day yesterday, bouncing back today. South of the border, a similar situation. Reaction to the tariffs yesterday, AI concerns, tech stocks sell-off. Today, bouncing back. You can see the S&P 500 up by 0.83, the Dow by 0.9, NASDAQ up by 1.13. Well, nations across the globe are pushing back against U.S. President Donald Trump's latest tariff threat. CTV's Judy Trin reports.
My fellow Americans, this is Liberation Day.
Donald Trump's use of emergency economic powers to impose tariffs has been shackled by the Supreme Court, but the White House says it will use other tools to get what it wants.
We had to look at backup plans, and we found ways to really reconstruct what we're doing. Now it doesn't have the same flexibility.
Trump says he'll now impose new 15% global tariffs to replace the ones deemed illegal. He warned against playing games and threatened much higher tariffs if countries back out of trade agreements. In the past year, the U.S. took in more than 240 billion Canadian dollars in duties.
He needs to return that money, needs to refund that money with interest. He can do that in a nanosecond.
Lower courts will decide if refunds are needed. Amid the uncertainty, the European Union is pausing ratification of its deal with the U.S.
We are trying to maintain predictability for businesses, for consumers, in the face of some substantial unpredictability.
The Supreme Court decision won't apply to tariffs that are devastating Canadian steel, aluminum, automobiles, and softwood lumber. Earlier this month, some Republicans joined Democrats to vote against Trump's tariffs on Canada. Ontario's premier emphasized the president's weakening support.
We saw what happened in Congress. We saw what happened in the Supreme Court. The walls are closing in, I believe, on President Trump right now.
Protected under CUSMA, most Canadian companies will be exempt from Trump's new tariffs. The Prime Minister has yet to comment on the president's new threats, but Mark Carney is preparing for an overseas trip. He's heading to India, Australia, and Japan later this week to increase trade with those nations.
And that was CTV's Judy Trin. Loblaw will invest $2.4 billion in 2026 with plans to build 70 new locations, create more than 9,000 jobs across the country. CTV's Adrian Gobriel files this report.
With Canada now home to the highest rate of food inflation among the G7, one of the country's largest grocers is setting the table for a sizable expansion.
It says we're here, we're optimistic, we want to continue to grow.
Loblaw Canada is investing $2.4 billion in 2026, with plans to build 70 new locations and create more than 9,000 jobs. The National Grocers Plan will focus on building new Shoppers Drug Marts, No Frills, and Maxis for budget-focused customers.
I think it's definitely a sign of the times.
Loblaw says it plans to open 4 new stores in Atlantic Canada, creating 600 jobs. 15 new locations in Quebec will create more than 1,985 positions. Ontario will receive the largest boost with 27 new stores and 3,775 additional jobs. Provinces to the west will welcome 24 locations, creating more than 3,400 roles with the company. Food economists say grocers are taking notice of cost-conscious consumers.
Grocers focus on 2 things. The first is share, that is getting people to walk into your store. And the second is basket, which is how much they spend when they come in. And if either of those goes down, they feel the pinch.
A statement from Loblaw in part says that opening new stores and pharmacies, especially in underserved areas, will help make value and healthcare more accessible.
They're not leading consumers, they're responding to changes in consumer buying habits.
Loblaw's push to expand its discount options is part of the company's 5-year plan to spend $10 billion by 2030.
Some economists expect the company's upgrades to look similar to this. Just 2 years ago, this was a Loblaw's. It's since been rebranded and retrofitted as a No Frills, a sign of a shifting marketplace. Adrian Gabriel, CTV News, Toronto.
All right, let's take a look at what is trending today, and we'll start off with bookingholdings.com. Booking.com is likely what you know it as, and it's going to slash customer service costs with AI, the CFO is saying, and right now there's some reaction to that maybe. It's up 4.22%. Also seeing a bump today, Home Depot on its earnings report. They weren't expecting a lot, but it did beat what people were expecting, and you can see that in the market responding right now, up about 3%. And take a look at Keysight. Holy cow, it is up 22.24%. And that's based on the outlook raised on AI demand. They're expecting above 20% growth for revenue and earnings in FY26. So that's why Keysight is soaring right now. Now going the other way, Fair Isaac is off 6, almost 7%. No real clear indicators. I was looking for some news on this, and I'm not really seeing anything. Just a downgrade. All right. Planet Fitness. Moving on to that, and it's off by 8.2%. That was on a slow, implying a growth slowdown in 2026. The fourth quarter results coming out. It looks like earnings and sales may be a little slower than they were anticipating. So that's driving it down. And then last up, Whirlpool is another one we want to look at right now. And it slides on it's sliding mostly on an $800 million stock depository share offerings is what's taking the hit on that. It tends to use the net proceeds from the offerings to repay a portion of the amounts outstanding under the company's revolving credit facility and for general corporate purposes, but you can see it's off by 12% right now. Coming up, the largest U.S. nuclear producer beat on Q4 revenue. We'll break down Constellation Energy's results after this. Shares of Constellation Energy are on the rise after the U.S.'s largest nuclear energy provider posted fourth quarter revenue that beat analysts' estimates. However, the energy producer missed on earnings and did not provide a 2026 outlook, pushing guidance back to late March. To break down what all this means for the future of the company, we're joined by Ryan Levine, Senior Equity Analyst at Citi. Ryan, thanks very much for joining us.
Thanks for having me.
All right, what led the beat?
So the general commodity prices have exceeded analyst expectations, and they're slightly offset by some of the production tax credit realization during the quarter. But I think the bigger story is less about the quarterly print. It's more about expectations for next month into the integration of their Calpine acquisition, and then broader expectations around new build generation, and then their ability to sell their existing power generation fleet for premium pricing to hyperscalers.
That sounds like a lot in 1 month.
Yeah, so they recently closed the Calpine acquisition, which did not impact the Q4 results, but on a go-forward basis, it's going to be incorporated into their 2026 numbers and then their broader outlook. We're assuming some modest synergies through that acquisition, and then when we refresh our models for forward curves for power and commodity prices, we see additional uplift into the outlook. But that drives their kind of short-term or intermediate-term outlook for earnings and cash flow. But the value creation opportunity is more centered around the hyperscaler or data center opportunity, both with their existing fleet, and then we're reminded of their platform to be able to deliver value by building new generation on a go-forward basis.
Are they putting all their eggs in one basket with that, with the data centers, or do you feel there's enough, they've got it spread out enough that they can weather anything?
I mean, the base business is very insulated from the data center story, but in terms of the stock and the valuation, the upside is more tied to data centers than anything else. The large industrial consumers are not going to be able to underwrite new generation and upgrades and expansion of their fleet the way the hyperscalers are. So they're very centered around trying to leverage this commercial opportunity with data centers and hyperscalers across their footprint. I mean, in terms of its concentration, with this Calpine acquisition, they've diversified their geographic footprint, so they're not as exposed to the PJM and Midwest market or MISO, and now have more exposure into Texas and California through this integration. So they have a more diversified product offering, both nuclear, gas, geothermal, and other power resources to be able to serve the hyperscaler, but they're still very centered around the data center opportunity in order to extract value in this landscape.
Any concerns about the impact? There's been a lot of talk. You're seeing some growing concerns about power use by data centers in areas, in some areas saying we don't want them there. Any concerns about that having an impact on them?
Yeah, it's a big concern. We at Citi recently raised our power demand forecast from data centers earlier today and increased it meaningfully. But your concern is very well taken. The certain communities are going to push back around data centers coming to town, which is why we believe there's more value creation opportunity for building new generation as opposed to taking existing plants and selling them to hyperscalers, which ultimately would drive up the cost for the general public. So it's more regional in terms of the impact to the community. But when you look at the markets that Constellation operates in, it's a top of mind. It's leading to political outcomes. We're leading to regulatory outcomes in Pennsylvania in particular. There was a policy decision recently in Pennsylvania with the Utility Commission that is trying to lower bills for the general public while creating an opportunity for economic development with new generation that Constellation, through their operates and their building, will be able to enable. On that front, on the big nuclear plant in Pennsylvania, in our note out this morning, we highlight that we think that plant will be ahead of the revised schedule based on some unique data that we've been tracking.
And so when do you think that we might see it online?
So we're modeling that it'll be online by July of 2027, which is a few months ahead of the company's formal stated in-service date.
And long-term contracts, how are they looking? Things stable there?
Their existing contracts are stable. If anything, there's upside potential to the existing assets through uprates and licensing extensions with the Nuclear Regulatory Commission, which we would assume are going to happen without much pushback. I think the bigger challenge is less on the regulatory and the existing assets, more about the new builds. And there's a concept that's emerging where everyone gets cut, and everyone bleeds, but no one dies, in terms of the financing structure around how you actually could build new generation, which is an opportunity for the company, but not baked into our valuation.
All right, just one last question about their 2026 report or look ahead, and it's not coming out till end of March. Any reasons for that? Or is it all tied in with they've just got so much going on over the next month or so?
Yeah, I think the biggest reason for that is just the integration of the Calpine acquisition. I think we were hoping that they were going to be able to come out with an updated guidance by this morning, but the merger integration and the accounting probably just took a little extra time before they can wrap everything in a clear picture around the outlook that incorporates the merger integration efforts.
Okay, Ryan, thanks very much for joining us. We'll end it there. Appreciate it.
Thank you.
Ryan Levine, Senior Equity Analyst at Citi. Coming up, we'll look at three plays in media and entertainment, one of which is the largest live entertainment company in the world. Stay with us. Time for Hot Picks, and we zeroed in on three plays in media and entertainment with Jason Bazinet, Managing Director, Media and Entertainment Research at Citi.
Consumers are increasingly wanting to go out and see their favorite artists in person. And so the concert business has been growing, very comfortably in the double-digit pace now for quite some time. And we don't see any evidence that that's going to end. The thing that's exciting about Live Nation is they're about in the third year of, I'd call it backward integrating into more venue ownership, which carries much higher margins. And so this company used to spend $200 million a year on CapEx. For the last couple of years, it's been over $1 billion. And that's a very good thing because their returns on invested capital are at record levels. And we just want them to keep spending money. When they spend the money and they own the venue, they just get much higher margins because they get site lease fees. They control the food and beverage at the venue. They get sponsorship revenues. And so it's a very favorable mix shift.
And just tell us, so they've been on a real estate buying spree?
Yeah, they've been acquiring venues outright. They've been building some from scratch. They've been deploying capital to renovate older venues and give them a refresh. One of the big assets they just bought was a sports complex in Paris, and they're retrofitting it so it can handle concerts. And so it's a very exciting time for Live Nation.
And apparently they're so, you talked about hospitality, which would include beverage sales. Apparently, I hope I'm not out of date. I'm looking at a 2024 story. Apparently, you could buy a can of liquid death water, the exclusive water vendor at hundreds of Live Nation venues for $7 US. And Live Nation has had an ownership stake in that water brand for quite a few years. So they make money in all kinds of ways.
That's absolutely true. I mean, at their amphitheaters, the average fan is probably spending, $45 to $50 on merchandise, food and beverage. So there's just an insatiable appetite on the part of consumers. Live Nation used to call themselves, an accidental retailer, where, you'd get a warm beer and a cold slice of pizza. And they've been, radically upgrading sort of their offerings to appeal to consumers that are willing to spend, more money to get something that's better. And to your point about liquid death, I mean, there's clearly a push for consumers to be a bit more healthy than they were in the past. And so they don't just sell alcoholic drinks, but they also sell water.
Tell us about AppLovin. To my understanding, this company makes it easier to create your own video game.
Yeah, it's not so much create your own video game. Their customers, their core customers, about 90% of revenues are the video game, mobile game customers themselves that are looking for installs. And so they can go choose to spend their user acquisition money on their own, or they can choose to do it through AppLovin. And AppLovin has some AI tools that can put the right ad in front of the right person.
Oh, I see.
To make the user acquisition spend more effective for the mobile game publisher. In very short order, AppLovin has gone from an AI winner to an AI loser, which is why the stock is down. But this company, continues to put up, 70+% growth. They've done that for the last 4 years. Where the stock is trading right now, even with that very healthy top line growth, it's trading at a high teens multiple of next year's free cash with no debt. I mean, it's just absolutely on sale.
Right. And that's interesting. So the app developers are the ones it's aimed at, not so much the consumers.
That's exactly right. So the way it works is the mobile game publisher sends AppLovin, says, I want to spend some money, and AppLovin and goes out and buys mobile game inventory on behalf of the publisher, and then AppLovin gets paid if the consumer actually downloads the game.
And then your, your final idea here, also video games, Take-Two Interactive.
Yeah, I mean, we've got Grand Theft Auto 6 coming out in November. That sort of consensus, I wouldn't say we're variant there. The really interesting thing that I'm focused on is on the balance sheet. They have a line item they call capitalized software development costs, which is essentially cash that they've spent developing games that have not yet been released. That number used to be a few $100 million. It sits at $2.2 billion. And my hunch is that there's a game that where the company has spent the cash but not yet released it and therefore not amortized it. That is Grand Theft Auto, but I think it's something else. And I think that something else might be a Red Dead reboot, which came out almost a decade ago. And so what I'm excited about for the stock is not just the Grand Theft Auto release in November, but potentially a Red Dead release maybe the year after.
What is Red Dead? What sort of a game is that?
Oh, it's like an open world Western. That's the way to think about it. So, you'd ride a horse and you have a gun and you walk around. And it's considered by video game aficionados as, maybe the most realistic open world game that's out there, even more so than Grand Theft Auto.
Oh, my goodness. And I guess we're just in the Stone Age. Games are going to get more and more immersive, aren't they?
Yeah, I think they are. I mean, that's what's very interesting. The market right now is just looking at all of these AI tools and viewing it as just a negative across the board. The market's painting with sort of a broad brush. I would argue that a lot of these tools are going to be used to lower the cost of development for a lot of these publishers. Mm-hmm. I mean, going back to AppLovin, if you let's say you take the maximalist, AI view, which says AI can just create games, at low cost everywhere for everyone. What's really going to happen is user acquisition prowess is going to be at a premium, right? This is why the mobile game companies spend so much. They spend 30% of their revenue acquiring users. Why? Because it's so easy to make a mobile game. So if you believe in AI and you think it's going to be really easy to make a game, that should redound to the benefit of a company like AppLovin that specializes in user acquisition.
Because the cost as games become more complex, the cost of creating them has soared.
Yeah, that's right. So AI will make it, I think you'll have more games, cheaper games. There'll be a proliferation of games out there. And then having user acquisition, acumen, which is what AppLovin does, should be at a premium. Because at the end of the day, you need to get an install, right? It's not enough just to have some fancy graphics on a screen, which is what Jim and I and others, are rolling out. It's like, how are you actually going to get users? And that's hard, and it takes a long time.
It's interesting. We're almost out of time, but apparently older adults, especially baby boomers, they're all over video games. It's not just a teenage boy thing.
Oh, that's 100% right. I mean, your typical consumer on the mobile gaming side is an older female. On the AAA games, you're right. It's about half male, half female, and it spans all age groups. I can't say on the AAA games, like Grand Theft Auto or Red Dead, that we're seeing a lot of volume growth.
Okay.
Where they're getting most of their growth is getting consumers to spend more inside the game once they purchase it.
And he was speaking with Jason Bazinet, Managing Director of Media and Entertainment Research at Citi. Traders on Kalshi and Polymarket are wagering on everything. We'll take a closer look at this emerging market after this. FedEx has filed a lawsuit seeking a refund for U.S. President Donald Trump's emergency tariffs. The transportation company did not provide the dollar value of the refund. Club retailer Costco and cosmetics giant Revlon also. Two of the companies looking for tariff refunds, more than $175 billion U.S., subject to potential refunds after the U.S. Supreme Court overruled Trump's tariffs on Friday. Bloomberg News is reporting that Canadian generic drug manufacturer Apotex is looking at the first half of the year for an initial public offering that could raise as much as $1 billion. An IPO of that size would be Canada's largest debut since 21. The report says no final decisions have been made on the exact timing or size of the offering, and plans may still change. Apotex was founded by late Canadian businessman Barry Sherman, who was murdered. Shares of Novo Nordisk are falling today. The Danish company plans to slash the U.S. list prices for Wegovy and Ozempic next year by as much as 50%. This comes as the drug maker struggles to claw back a larger share of the obesity market. The cuts will apply to wholesale acquisitions and not self-pay prices. However, they may reduce out-of-pocket costs for some patients. Taking a look at the markets. TSX looking solid right now. It is up 0.42% as it heads toward 34,000. See if it hits it in the next couple of days. And south of the border, lots of green down there too. Tariff fears easing down there. S&P 500 up by 0.75 point. The Dow by 0.88 and the Nasdaq by nearly a point. Traders on Kalshi and Polymarket are wagering on everything from championship games to federal news conferences. Critics calling it unregulated gambling. For more on today's Big Take, we're joined now by Christopher Beam. Christopher, thanks very much for joining us.
Thanks for having me.
How long have prediction markets been around? They seem like they've burst onto the scene, but they have been around for a couple of years now, though.
Yeah, prediction markets have been around actually for a couple centuries, depending how you define them. People bet on elections as far back as the early 19th century, and some scholars have said that those markets were actually quite accurate in predicting the outcome of elections. But what we now think of as modern day prediction markets have really been around for a couple decades. Mostly they focused on elections starting in the late 80s and 90s. But now, if you go onto Polymarket, Kalshi, you can see anything from elections to sports to betting on the Oscars or even on the weather tomorrow.
And how do they work? Do they just build up information and because they can process it so fast?
So the way it works is any given person, you, me, can go on to one of these platforms and place a bet on a particular market. And the market is framed as a yes or no question. So one of the better known markets out there right now is, will Jesus return in 2026?
And what are the odds?
And if you believe the answer is yes, you can buy a contract and you're matched up with me if I believe the answer is no. And whoever wins that bet gets $1. And you were just asking, what are the odds? I think the odds right now are quite low, but last week or the week before, they were as high as 5%.
Wow. And so do you need someone to take your bet, or can you bet against the company or whatever who's providing the service?
So what the prediction market companies emphasize is this is peer-to-peer. So if you want to bet yes, the platform will match you with someone who wants to bet no. Or if they can't find someone who wants to bet no right away, they have market makers. They have companies that come in and match those bets and essentially hold those contracts until they can find a buyer. But fundamentally, what happens is if you bet yes and I bet no, and a million other people also bet, that will set a price. And say the price for Jesus coming back is 5 cents. That means people think the odds are roughly 5% that will happen this year. And so that's why people call them prediction markets.
And so obviously people are making money on it. Is this taxable? How are regulators handling this?
So the regulation is very much up in the air right now. In the US, the CFTC technically regulates derivatives markets, and the prediction market products are technically they're called event contracts, which are a form of derivative. So they fall under CFTC jurisdiction. However, there's a whole slew of court cases that are playing out right now where state gambling regulators are suing Kalshi and in some cases Polymarket, arguing that this is not trading of derivatives, it's actually gambling and should therefore be regulated by the state. And long story short, the states would treat prediction markets much more strictly than the CFTC does right now.
And of course, I mean, this raises the question, can we call it insider trading? Is that what it is, market manipulation?
Well, it depends on the case, but at the very least, it introduces this whole new debate over how to define insider trading. So, you know, when it comes to stocks, when it comes to other forms of heavily regulated financial products, there's a long history of the SEC and CFTC deciding what is and is not insider trading. When it comes to prediction markets, it's a lot less clear. For example, you know, if you're betting on what Trump will say in the State of the Union tonight, and some Trump staffer decides to participate in that market, is that insider trading? Well, there's no rule that Trump can't tell one of his staffers what he's going to say. And so these are all questions that are so far unresolved, and a lot of people think the CFTC needs to be more clear on its definitions.
And have we seen cases? Have people been accused of this?
Absolutely. The best known case that you might have heard of is there was a market on Polymarket where people could bet on whether the U.S. would invade Venezuela and President Nicolas Maduro would be captured. And there was one account that bet a large amount and made about $400,000 betting that Maduro would be captured on a particular day. And we don't know who that person was, but in a case like that, I mean, that was on Polymarket, which is overseas and unregulated. But if that were on a market that was based in the US and regulated, the platform would refer that case to the CFTC and they would launch an investigation.
All right. Would you care to bet that we're out of time and we have to wrap this up?
Approaching 100%.
All right, Christopher, thank you very much for joining us on this one. We appreciate it. Take care. Christopher Beam is with Bloomberg's The Big Take. Coming up, shares of Novo Nordisk are under pressure today after the company said they would dramatically reduce the cost of Wegovy and Ozempic starting in 2027. Stay with us. Shares of Novo Nordisk are seeing pressure today as the Danish company plans to slash prices for Wegovy and Ozempic starting in 2027, and all in an effort to improve affordability. Well, some have suggested this move is a competitive pricing decision. Our next guest says today's price cut doesn't reflect a price war. Let's get more from Evan Sigerman, Managing Director, Head of Healthcare Research at BMO Capital Markets. Evan, thanks very much for joining us. Rough day for Novo Nordisk. Also, the CagriSema is how you pronounce it. Disappointing results on that.
Yes.
CagriSema, sorry.
That was yesterday.
Disappointing results.
So, a few things to think about here. One, we can talk about CagriSema in a second, but I think what's really important when you look at the announcement today around pricing, they're talking about the list price. And drug pricing in the United States is pretty convoluted. Most people don't pay the list price, or they don't realize the list price. That's kind of a starting point when it comes to negotiations. So what's happening here is by lowering the list price, they're able to reduce deductibles, co-insurances, co-pays that a patient with commercial insurance might have to pay so they can get access. It doesn't change the net price that Novo realizes when they sell, a Wegovy pen, for example. We confirmed that with the company. So we don't think this is a price war. It's a good headline to show that they're thinking about price. It should help out-of-pocket cost for some patients, but it doesn't change, their business model fundamentally in our view.
Just kind of on the side on that, any concerns that insurance companies will kind of absorb some of those reductions and the people will still end up paying?
I mean, TBD, there's a lot that goes into contracting. When a patient has a deductible, for example, say it's a $3,000 deductible before they, their insurance kicks in, they're paying the list price. So if the list price is $600 versus $1,000, they're only paying $600 to get that prescription. A lot of co-insurance is also a percentage of the list price, say 20, 30%. So if you lower the list price, you lower the co-insurance. So that should help. In terms of kind of the rebates and discounts, that's a different negotiation between Novo and the plans, kind of the payer. I doubt that that's going to change significantly, especially given what the company said about net pricing.
And was Trump a factor in this? He's been pushing to make healthcare more affordable and prescriptions more affordable. Is that playing a role?
Great question. So, explicitly, no, we confirmed this with the company that this wasn't part of the MFN deals that we saw back in November. But more broadly speaking, I think anything as it comes to drug price affordability, especially out-of-pocket costs, right? The administration in the United States talks a lot about the out-of-pocket costs for people with insurance. And if Novo is proactively doing something to fix that, I think that goes along the theme of what the administration is trying to achieve. So while it's not an explicit deal, kind of you need to do this or we're going to, negotiating to have this done, it is along the lines of what the administration wants.
And is this maybe trying to rebrand a little bit? Because, Big Pharma doesn't have the best image. Is this part of it too, you think?
Hard to say. I think kind of the rebranding of Big Pharma is a larger conversation and a more complex topic, right? There's a lot of, kind of thoughts that goes into it. And there's a lot of nuances, especially when you factor in kind of the influence of the PBMs and insurance companies. But I think that a headline like this definitely helps Novo's image, at least kind of on the margin.
And not coming until 27. So why wait till then? Why not come in earlier?
Because I think that it takes a lot of time to actually kind of implement changes just in the broader system. A lot of the contracts for 26 are already set, and it would maybe actually cause more kind of turmoil in terms of affordability and accessibility. And remember, the cash pay prices are really affordable. The Wegovy pill starts at $149 a month, so that's far below any of these new list prices.
And how are they doing in this is such a huge sector and such a huge business, the weight loss and obesity drugs. Are they still holding their own?
So if you go back a few weeks ago around 4Q earnings in 2026 guidance, Lilly had a much more positive outlook. They forecasted a lower net price reduction. In the United States, Novo had a poorer outlook for 2026. So we do see a bit of bifurcation. They're still selling a significant amount of, their products, whether it's Wegovy, the Wegovy pill, or Ozempic for diabetes. But I think that, it's not the explosive growth that we saw, in the past couple of years. The Wegovy pill, though, is doing very well, and script numbers really suggest that it could be tracking to be upwards of $1 billion, potentially $2 billion in sales this year alone.
And then CagriSema, what kind of an impact does that have, the results that we saw?
Great question. So CagriSema was supposed to be their answer to kind of a higher efficacy weight loss product, more akin to Lilly's Zepbound. And, the data disappointed. It was supposed to be shown to be non-inferior. It actually was inferior, so it produced less weight loss than Zepbound did at the same time point, which was 84 weeks. And it really puts a question mark into how Novo is going to compete with Zepbound, Lilly's retatrutide, kind of some higher efficacy products, because Wegovy is a good product, but kind of at its peak, it's about 16% weight loss. CagriSema gets you into the 20s. But some patients need more than that and need a good answer for something if Wegovy is not kind of going to work for them.
And do they have anything else in the pipeline, or are they going back to the drawing board with this?
Yes and yes. So they have other things in the pipeline. They're looking at a higher dose of Wegovy, so a 7.2 milligram that gets potentially better weight loss with just one product. They're looking at something called amycretin, an amylin targeting asset. But when it comes to the drawing board, I think that they may have to potentially acquire, push forward some of their earlier assets that are dual or triple agonists. But they definitely need more than just Wegovy or semaglutide in their portfolio.
Okay, we'll leave it there, Evan. But thank you very much for joining us.
Thank you so much.
Evan Seigerman is Managing Director, Head of Healthcare Research at BMO Capital Markets. Still ahead, we'll take one last look at the markets before we go. Know Your Options is back. Tune in Wednesday at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions to knowyouroptions@bnnbloomberg.ca. Well, Bank of Nova Scotia top estimates on better than expected results at its Canadian banking division as the firm pushes to improve performance at its most important unit. For more on the Scotiabank results, we sat down with Christine Dobby of Bloomberg News.
The interesting thing was they had good results across all of their divisions. They beat expectations in Canadian banking as well as capital markets and wealth management, and in their international division, which they have been really working on turning around. This was an area where they saw the completion of a transaction to divest of their Colombian assets that closed during the quarter. So that was interesting to see. But yeah, when you listen to the earnings call, there was really a sense of optimism from CEO Scott Thompson that this is the result of the long-term plan that they put in place to turn things around, and it's starting to pay off. They're talking about meeting their return on equity targets a year ahead of schedule, even.
So it sounds like they're getting a lot of things right. What have they changed that to turn it around like that?
So in their Canadian banking business, which has been a real focus of where they've been really looking to improve, it's been a bit of a story about optimization or rejigging to focus on this idea of primary clients, that is, clients who use Scotiabank across a range of their products. So they haven't really returned to loan growth in that area. They're more focused on getting these clients who bank with them across all these different areas. And they've also done cost cutting to improve efficiency there. They took out a lot of costs last quarter, which did involve a number of job cuts.
Okay, and risk for investors, concerns they should be keeping an eye on?
Yeah, so the other interesting thing on the call today was they did get a lot of questions about credit and their provisions for credit losses, potentially bad loans, did come in a bit higher than analysts had forecast. They reiterated that they think that impaired loan loss provisions will remain pretty elevated for the first half of the year and likely come down in the second half. But that is contingent on the broader economic picture, which, as we know, can change at any time. And one area that they talked a bit about on the call on several occasions was mortgages that had been taken out during the pandemic era. As you'll recall, home prices were very high at the time and interest rates were very low, and that has basically flipped on its head since then. So some of those mortgages in the GTA in Ontario are experiencing a bit of stress.
That was Christine Dobby of Bloomberg News. Let's take a quick look at the markets before we go. And we'll start with the TSX. You can see it's at 0.47, almost a half a point, and into record territory if it can hold. Not record intraday, but if it holds like that, it would be a record high close. So we'll see what happens. S&P 500 up by 0.82. The NASDAQ rallying as well. More than 1% it's up right now after yesterday's sell-off. Let's take a look at some of the winners and losers at the moment in the TSX. First up, we got Thomson Reuters. It is absolutely surging. It's up 12% right now in the wake of that Anthropic mention. At one point, it was up about 14%. And the company's had to hit a milestone of 1 million stakeholders in its company, 1 million people into its company right now. Quite the milestone for it, using its information services. And a few others to look at. Curaleaf Holdings, just on the roller coaster. It's up 11% right now. Going the other way, Winpack down on its earnings that came out. It missed, and you can see it's up by 3.6. Loblaw made those announcements yesterday about its spending plans, and investors not liking that right now. And TerraVest is also having an off day. It's down about 2 percentage points. And that wraps up this edition of Trading Day. I'm Roger Peterson. Thank you very much for joining us. Have a great afternoon.